Hi, and welcome to this EarningsBeats weekly market recap for the week ending July 5th, 2024. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and it's a pleasure to join you all this weekend. Well, it was a very interesting week for sure because we had a lot of disappointing economic news. Even though Friday's non-farm payrolls report came in 17,000 above expectations, the prior month, back in May, it was actually revised lower by 54,000 jobs. So the net actually was a disappointment on Friday. And when we had the ADP employment report come out on Wednesday, same thing. We came in 11,000 shy of expectations. Throw in initial jobless claims on Wednesday, which were about 5,000 higher than expected. And the factory orders, which came in negative while we were expecting positive numbers there. And most of the economic numbers that came in all week really were mostly negative. So the market had that to deal with, but rates were dropping, so that was good. And we also heard the latest from Fed Chief Powell talking about still need to get inflation down to a more comfortable level. So he's still leaving a little bit of uncertainty out there, although in my opinion, I don't think we're going to see any change in interest rates at the end of this month, but I do think we're going to see a rate cut in September. Call it a gut feeling, I'm not sure, but I'm seeing a lot of things that suggest to me that the Fed needs to lower, especially these reports, economic reports that are coming in disappointing. The risk that the Fed runs, and there are a lot of folks out there that say, well, wait a minute, if the economy, if everything's still positive and inflation's coming back, why do we have to touch rates at all? I mean, why don't we just leave them there? The problem is the economy is starting to show cracks in the foundation, and these reports are just kind of illustrating some of the problems that we could be facing down the road if rates don't come back down. Remember, rates didn't go up because of a strong economy. Rates went up because of inflation. So now that inflation is coming back down, the Fed is okay to lower because like I said, the economy it's still okay, but it's not great. And so I think the Fed has the ability to begin cutting rates. What we don't want to do is wait until the economy starts showing signs of a recession. And then at that point, it's probably going to be too late to cut rates. So this whole soft landing that we've been talking about for the last couple of years that the Fed's been shooting for, it's still out there. But I do think the Fed, in order to achieve it, is going to have to cut rates before the end of the year. And in my opinion, I think that's going to start in September, but we'll see. Let's go ahead and take a look at some of the action from last week. So I'm going to start off with the Dow Jones, which on Friday finished up 67 points. The S&P 500 finished up 30. NASDAQ 100 up another 205 points. And I should mention, with all the bad news that was out there last week from an economic perspective, and there really wasn't much at all from an earnings perspective, but with all the economic news that came in below expectations, the S&P 500 and the NASDAQ both closed up every day this week: Monday, Tuesday, Wednesday, and Friday. Of course, we had a holiday on the 4th, but the other 4 days were up, and the S&P 500 and NASDAQ both finished at all-time highs on Tuesday, Wednesday, and Friday. So the market is loving the week economic news because, in my opinion, they are factoring in that absolutely we're going to start getting rate cuts. And when the Fed finally announces the rate cuts, honestly, I think that's when probably the problems are going to start kicking in. I think as we get closer to the September meeting, I think the market's going to begin pricing in rate cuts. And I think it's going to be one of those situations where it's going to be buy on the rumor and it's going to be sell on the news. So I wouldn't be surprised late August, early September. And this is what I've been talking about. I think that's when the stock market may begin to have some problems, just when all the good news starts to come in on rates. That's the way the stock market works. It doesn't wait for the good news and then all of a sudden everything goes up. I mean, look at the S&P, look at the NASDAQ. They're going straight up. Market is anticipating the news that we're going to get later this year. Anyhow, mid caps down 22, small caps down a point. On a percentage basis, mid caps down 0.75% on Friday, small caps down about 0.5%. Both of those groups really struggled this week after getting off to a good start on Monday morning. It was mostly down after that. And really, if you look over here, the Dow did something similar. I mean, we were kind of at the high early in the week and then struggled to close back above those levels. So really the strength we saw was on the S&P 500 and on the NASDAQ. And in particular, there was about 5, 6, maybe 7 industry groups within the aggressive sectors that really led the market action last week. Anyhow, transport's down about 0.75% on Friday. We did continue to top out around that 15,500 level, rolled back over, finished at 15,279 on Friday. So we do still have multiple levels of resistance on the transports that we need to get back through. Looking at the AD lines, I see some pretty positive stuff going on here. The Dow, even though we're not breaking out to new highs, AD line, new highs. The S&P going up, setting new record highs, AD line going up with it. NASDAQ setting new record highs, AD line going up with it. And even the mid caps, which have been under pressure here for about the last 7 weeks or so, look at that AD line setting new highs, going up and setting new highs. So it looks to me like there's accumulation in the mid cap area, even though prices haven't reflected it. IWM, a little bit similar. I mean, we've been pulling back and that AD line is actually doing better. That's certainly better than what we saw back in March when the IWM was going up and we peaked on the AD line and started coming back down. I think that was a telltale sign that we weren't quite ready for that breakout. Now the AD line's holding up pretty well. I would still, as far as small caps go, let's see that breakout. I've been talking bullishly. I still think second half of the year, we're going to see some strength out of the small caps. But at this point, I want to see that breakout before I really get aggressive in the small caps at this point, because I've kind of gone back and reweighted into the QQQ and the spider. When we get that IWM breaking out, then I think we got a different story. And I really want to see it to the downside, hold about 197, 198. I don't want to see any more lows here. If the market does continue to strengthen as we move toward Q2 earnings season, I'd like to see the IWM move up with it. So far, that really hasn't been the case. Looking at sectors, this is the part that's bullish for me. Discretionary leading on Friday, technology, communication services, and financials. 4 aggressive sectors leading the market advance that we saw on Friday and really leading throughout the week. These are groups that we want to see showing strength when the market's going up, and they were doing that for sure. Especially, you can see communication services breaking out. You can see consumer discretionary going straight up. If you recall, it was probably about a week or 2 ago when I was talking about maybe technology on a relative basis, maybe taking a little bit of the back seat and letting communication services and consumer discretionary take over. That's really what we've seen. So technology hasn't fallen apart, but the other 2 areas have been keeping up with technology, if not outperforming it. Certainly the XLY with Amazon and Tesla moving higher. Those are the 2 most heavily weighted stocks in the XLY, and we're clearly seeing strength in that area. Autos, you can see the big move in the autos. That's almost exactly what's going on with the Tesla chart. We'll look at that a little bit later in the show. And I also wanted to point out, because I'm not a big gold fan, but the gold mining stocks did really well on Thursday and Friday, jumping. And some of that was after, I said Thursday, Friday, Wednesday, Friday. Some of that was based on what the Fed talked about. And I think the Fed, is still, even though, they're remaining adamant about 2% and want to see more, I think the bond market reacted and we saw yields coming back down later in the week. And I think that's what kind of gave mining stocks a little bit of a lift, because as rates came back down, so too did the dollar. And when the dollar came down, that gave mining and precious metals an area, or at least a background where they could thrive in short term. So I'm not, and I've said this many times, I'm not saying I think gold, silver, and many of the commodities are going to go lower. What I've said and what I continue to say is I don't think they're going to be outperformers. I would not be surprised if over the next couple of years, gold moves up to 3,000. I mean, I don't know where we at, 23, 2,400. I mean, I could see 3,000, but I just think the stock market's going to do better. So that's, as far as I'm concerned, it comes down to relative strength. I have an option to get into the S&P 500. If I'm going to do something besides get into the S&P 500, whatever I get into, I want to outperform the S&P 500. And I just don't think gold's going to do it. We'll see. If you look back at history, when gold outperforms in almost every single case, when it outperforms on a relative basis, it's when we're getting a big spike in the volatility index. So when the volatility index goes up and we start expecting more downside action or more volatility, which usually accompanies downside action, that is when folks will start to look at gold as a hedge. And that's when we can start seeing outperformance. So again, it's not that I don't think gold or silver or any of these other areas can go higher. I think in a secular bull market, rising tide lifts all boats. I expect everything pretty much to go up. But what's going to outperform the S&P 500? Personally, I don't think it's going to be gold. But I will give those who are in gold their due on Thursday or Wednesday and Friday, because both those days really, really solid action, not just in gold itself, but in the miners and some of the precious metals areas as well. So let's keep moving. Let's talk about the 10-year Treasury yield. So we had all these weak economic reports. So after gapping up on Monday morning, we saw the 10-year Treasury yield come all the way back down. Remember, Monday morning, we got up close to 450. Looked like, hey, we're going to make this breakout. We're getting through the 50-day moving average. Wanted to see it get through 450 because back earlier in June, that's where we had topped out. On this pullback, we went back up and got almost to 450. So wanted to see something build on that 450 to think that yields were really going to go back up and consistently move back, say, toward the 470 area. Didn't happen. So we saw that selling, or not selling, actually buying of bonds, which sends the yield lower. Those two always move inverse to one another. So if bond prices are going up, the yields drop. If bond prices are coming down, yields go up. So in this case, folks were pouring into bonds. Why do you jump into bonds? One reason is because the threat of inflation is ending. That's one reason to get into bonds. I mean, if you think inflation's still a problem, you're not going to jump into bonds when they're yielding a little over 4%, 4.25%, whatever. Because if inflation goes back to 6%, why do you want to hold a 4.5% bond? Doesn't make any sense, or 4.25%. So usually when folks feel like inflation is no longer a threat, that's when they want to get in and get that yield. If you think inflation's going back down to 2%, 4.5% is a good deal, because you've got, you 2.5 percentage points above inflation. So actually your money's actually making money. So anyhow, that pullback, I think, is another signal from the bond market to the Fed to say, hey, enough's enough. We're seeing our economic reports are getting weaker and weaker. You've got to be careful. You don't want to wait too long. And even Fed Chief Powell has said that himself, that is a risk, that if they wait too long to cut and the economy starts to fall and they can't stop it in time, that's going to be a problem on the other end. Because what happens when the economy falls? All of a sudden, you've got supply out there, but the demand isn't out there. So what happens? Inventories build. What happens when inventories build? You have to drop prices to lower inventory. So instead of inflation, you start talking about the possibility of deflation. And trust me, deflation is worse than inflation. So, the Fed's got to be thinking about cutting rates. And like I said, I think it's going to come in September, in September. I don't think it'll be in July. I'd like to see it in July. I think they could start cutting, but we'll see what happens. I think it's going to be September. Moving on, S&P 500. So here's the chart showing you the big breakout over here to the upside. Those are three white soldiers. If you're a candlestick fan, that is a bullish signal. When you're consistently, few days in a row, finishing on the highs, having hollow candles like that, this isn't a gap up with no follow through. This is buying 3 straight days in a row. Really nice looking chart, actually. NASDAQ 100, same thing. And remember when we first broke out and it looked like, oh, look at this negative divergence. And I said, be careful because it can be eliminated. Well, last few days as we've been moving up, look at the PPO starting to turn back up. We still have a negative divergence, but if we see another couple of days next week, solid action, we could see the PPO go back up to a new high. And then all of a sudden, it's a miracle. Negative divergence is gone. Poof. So something to watch for. Small caps. This is still an area that's concerning. I'm being nice with that word. I mean, seeing the S&P 500 and seeing the NASDAQ just absolutely flying again this week, and no love whatsoever for the small caps on a relative basis. Obviously, that doesn't look good on the small caps. So like I've said, I think that we are, I mean, if you look at a long-term chart of the IWM, let's go weekly, 5-year. Actually, we can go out monthly, 15-year. I mean, this is an uptrend. It kind of brings the downtrend that we've been seeing in 2024, or at least maybe the sideways consolidation. This is more perspective when you stretch it out and look at a long-term chart. The overall trend is higher. If I looked at a daily chart and looked, if this was a daily chart on the IWM, I would say, yeah, we're still in an uptrend. Watch, this double bottom down here, but otherwise we're trending up. We've been trending up for years. So the long term still looks fine. It's the short term where we're seeing underperformance in the small caps, underperformance in the mid caps, underperformance in the Dow, underperformance in transports. That's the daily chart. I mean, even the transports, if we look at it here, so this is on that long-term monthly chart. Does this look like a bad chart? I mean, if it actually looks a little bit like an ascending triangle. We had an equal highs here, and then the low, and now we've got rising lows. I mean, a breakout above, say, 17,000, I think would measure up to about 22,000. Now, if we see that, I'm pretty sure there'll be a lot of folks that maybe were bearish because of transports all of a sudden being much more bullish. And in time, I think that's what we're going to see. But when, I don't know. And it is frustrating trying to play in the transport area or in the small cap area when the others, the large cap, clearly continue to lead to the upside. On the daily, here's that transport chart I was talking about. You can see all these failures up here around 15.5 over the course of the last week and a half, getting up there, and it looks like it's rolling over. Maybe we hold the moving average and then bounce back up and clear. That would be a really good development next week on the chart if we could see that. So watch for that. At some point, if we do start to trend higher on the transports, we're going to hold the rising 20-day and we're going to start trending up above it. So far, we haven't done that, and that's why we continue to be in this sideways, maybe even short-term downtrend. But if we get back up through 15.5 after bouncing off the 20-day, that would be a good sign. Let's talk a little bit about the different industry groups, because 2 weeks ago when the semiconductors topped, I mean, I had it on my shows. I wrote about it over at Stock Charts. I've been continually talking to members about it. This rotation, first of all, rotation is a good thing in the stock market. Semiconductors went up from 9,000 to 21,000 in not that long of a period of time. What was it, since the end of October last year? The semiconductor index, the Dow Jones US Semiconductor Index, went from 9,000 in October of 2023 to hit 21,000 recently. That's unsustainable, folks. You can't go up 133% every 8 months. I don't care how good earnings are. You can only do that for so long. We saw the S&P 500 go up 115% in 22 months, and we know what happened after that. You remember that? That was the cyclical bear market. You just can't sustain that kind of a move in that short a time frame. I think semiconductors are kind of in that same quandary right now. I mean, it's just, I don't think that semiconductors are a bad group. Don't misinterpret. I don't think they're going to go crashing down. I just think that they might sit back. Maybe they consolidate. Maybe they pull back for a little while. But I could even see them just consolidating. And while they do and the market goes higher, you need other groups to lead. And so last couple of weeks, I've been talking about software. I can't tell you how many times I've been talking about software. Internet with Google. Broadline retail with Amazon. Autos with Tesla. All these areas I've talked about last week, this past week. Semiconductors actually were about, they kind of went along for the ride with the S&P 500, actually even a little bit of outperformance. But among the 10 best industry groups last week, autos, computer hardware was the other one, Apple. So you've got autos with Tesla, computer hardware with Apple, internet with Google. Meta had a huge day on Friday. Software, Microsoft is absolutely on fire. Broadline retailers, there's Amazon. And then semiconductors. NVIDIA is kind of struggling a little bit, but some of the other semiconductors are up fairly close to breakout, still down a little bit from the high a couple weeks ago. So I wouldn't exactly say semiconductors are screaming higher anymore, but at least they're just sideways consolidating, which is good. And they showed a little bit of strength here this past week. But those other areas, that's what I've been talking about. Those are the areas that typically help to lead during secular bull markets. Autos, computer hardware, I mean, Apple, obviously, Microsoft, and many of the software stocks. And that one's the one I really like because we've been talking about, last 3 or 4 years, software on a relative basis is about equal, versus the S&P 500, just about right where it was back at the end of 2020. 4 years later, here we are. Still, it's time. It's time for the software group to start moving higher, and we've been seeing that. And I'll show you a chart in just a bit. But here you can look at autos. Now, here's Tesla, and what I did here is I highlighted since about the 24th, so the 25th all the way through the 5th. And the reason that I highlighted that, I want to show you. We do a lot of research for our members at EarningsBeats, and that's really, I think, where a lot of value in our service comes in. But let me show you on an Excel spreadsheet. This is Tesla. Now, what I've done, and I mean, we could go through and look at this, but this is a chart that if you go all the way over here, I've been tracking since 2013. That's when the secular bull market began. And if you go all the way to the upside of the page, you will see, I mean, literally every single day of the year, here's Tesla's price. So in 2021, on May 24th, Tesla was 202.15. Then there's the next day and the next day. I've got every day on here for the last 11 years since the secular bull market kicked in on Tesla and 15 other stocks that we've been tracking. Now, I updated, this was through like the end of toward the end of the fourth quarter or toward the end of 2023. So I haven't updated it yet for this year, but this gives us a pretty good signal as to what's been going on with Tesla. And here's what I can tell you, just briefly. I have the annualized return for every day of the calendar year, but I don't really look at it like that. I mean, these 3 days, really crazy annualized returns, and then there's a bad day. And here's a really bad day, minus 733%. And a lot of folks be like, well, how can you lose 733%? Well, you can't. But when you only have 6 trading days and you're annualizing it to 250 trading days, if you have a loss here like we had of 17.41% on June 3rd, 6 days, but obviously not very good days, that's how when you multiply that out, that's how you come up with a big negative number like that. But what I like to do is just look for periods when Tesla does really well. And so one thing that I do is I come down and I summarize this all the way down here at the bottom. And you'll see the first calendar day of all months, second calendar day of all months. So this first day, so this is on all the firsts of the month. Obviously not January 1st because the market's always closed. But February 1st, March 1st, April 1st, May 1st, June 1st, July, all the way through the end of the year over the last 11 years. The first for Tesla, we've seen Tesla up 32 times on the first day of the month and down 43. But there's actually a gain, a net gain on those 75 days of 3%. And then you annualize it out and it comes up to 10%. There's the second. 6%. There's the third, 51.6% annualized return. The fourth, 239, but then the fifth comes right back down 198. So net, those two are like 41%. Then the sixth is 27%. The seventh is 79%. So you can see basically the first 7 days of the month for Tesla tend to be pretty good days. And if you go all the way down here to the bottom, look at what happens from the 24th to the 31st. I mean, we've got really strong days in there. Annualized returns are incredibly powerful. And so if I keep scrolling down, what you'll see, now the way I break this down is I break it down 26th to the 6th, the 7th to the 10th, the 11th to the 18th, and the 19th to the 25th. The reason I break it down is I wanted to be consistent with every stock versus the S&P 500. And these are the periods that if we look at the S&P 500, the 26th to the 6th is bullish, 7th to the 10th is bearish, 11th to the 18th is bullish, 19th to the 25th is bearish. And so I wanted to see how that's set up with every one of these 16 stocks. So with Tesla, the annualized return from the 26th to the 6th is 61.35%. That's pretty strong when you consider the S&P 500's annual return since 1950. The average annual return is 9%. So Tesla from the 26th to the 6th has been really strong. So if I go back over to that chart, what are we looking at here? Looks to me like it's about the 25th, 26th to the 5th. And of course, 6th is a weekend. They'll be on a Saturday. So, I mean, I think now that's kind of exaggerated. We don't see that every time at the end of the month or the beginning of a month. But this is a pre-earnings period for Tesla. And I wrote about this at Stock Charts. Tesla has a history of making some big pre-earnings runs. So, I think you need to at least be aware that Tesla has a tendency to make these big runs, and we're doing it again. So, and I talked about this and wrote about it over at Stock Charts before this move was made. I think actually it was starting to come up, and I said if it could clear 208, it could run, there really wasn't any major resistance until 265. Well, once we broke 208, look what happened. It's been a melt up. There's just, if you're looking to sell, you really don't see any major tops until you get back to 265, and there's 268, and there's 280. I don't know. I would think probably 265 would give Tesla a reason to pause. We'll see. We're only $14 away at this point. We're almost there. But anyway, I just wanted to point out, because if you go over to EarningsBeats, to our homepage, EarningsBeats.com, we have this Bowley trend market history. This is the S&P 500. It goes back almost 75 years, back to 1950. And so what we do is we reveal a lot of these trends. And if you don't know the way the stock market works historically, you are definitely behind the 8 ball when you're trying to trade. You need to know these trends. Everybody needs to know these trends. And so all you have to do is hit this, download the free report. You can go in, name and email address is all it is. Now, if you want to get the top 16 stocks, that spreadsheet that I was just showing you, we summarize all that data in part 2. So get part 1, get to know what goes on with the S&P 500. And then if you want cheat sheets, which is kind of what I call them, for some of the top stocks like NVIDIA, there's one fact about NVIDIA that you need to know, because it's where they make their huge moves. And they just did it again recently. Their huge move came during this exact same cycle during the year. So you need to understand these. Anyhow, go to EarningsBeats, click on that download the PDF, and then come in here, name, email address, and download that part 1 report. You won't regret it. It's completely free. So not going to be any charge. There's no credit card. If I'm handing it to you on a silver platter, take it. And then if you want more information, then that would be part 2. There is a nominal fee for that, but you also get our service for 30 days, paid service as part of that. So honestly, it's really not much. And you get a lot of great information on some of the most heavily traded stocks. Amazon and Google and Tesla and Netflix and Costco and Apple and Microsoft and all the big names. You need to know when they trade their best, because history does certainly repeat itself. Anyway, go make sure you check that out. So let's take a look at software. So here's software. I've been saying I really think this is a group that you need to be part of. Here it is moving higher. Look at the AD line. Software it's closing. We're getting almost a hollow candle every day. It's just going up and closing on highs almost every single day. And it's been doing it for about 5 weeks now. And if you scroll down, look at the relative strength. You see how we were in this downtrend channel for about 4 or 5 months since we topped on a relative basis back in February? We broke through that in mid-June. That's when I started talking about the software. I mean, it was back in here, and we've gone up probably another 400 points on the index since then. And I think it's just getting started. So I wouldn't be surprised to see software. I don't think it's going to have a run like semiconductors had, but I wouldn't be surprised to see 10,000 in the not too distant future on software. So this is a group I definitely would keep an eye on. Internet. So here's internet going up. Here's the AD line, strong as can be. And look at this sideways consolidation on in terms of relative strength. We broke out, we retested the breakout level, and now we're shooting back up again. Google, Meta both had big days today breaking out. And we'll look at, I know I'll look at Google. Maybe I'll try to remember to pull up Meta as well. Then we got the computer hardware. So here's computer hardware breaking out, pulling back, holding the 20-day and breaking out again. Continuing to perform well. Only thing that this one has that maybe worries me just a little bit, right now we've got the AD line, which has been trending down. So we're seeing more gaps and less intraday movement. I mean, you can see a lot of the red candles. We didn't see that in software or not computer hardware, but software or autos. I mean, both of those, we're just, cruising to the upside, gapping up and just continuing to move up all day. Computer hardware has been a little bit different, but still breaking to all-time highs. I generally don't argue with breaking to all-time highs because price volume is your number one indicator. It should be. That is your primary indicator. Everything else I talk about, AD lines, relative strength, PPOs, all of that, that's all secondary. Candlesticks, all of that stuff is secondary. There's only one primary indicator, and it's the combination price volume. All right, let's keep moving here. So we got broadline retail. Broadline retail had been consolidating. Look at it breaking out and rolling higher. Look at the AD line, new highs. Look at the relative strength. Just got up to a new 52-week high at 0.75, taking out the early May high. So these are the areas, that we want to be focused on because this is where the money is rotating. Now, let me pull up semiconductors. And semiconductors are not moving back to a new high yet. So there is that bearish engulfing candle that you need to at least honor until you can get through it. I'm not saying that we're going to go shooting straight down, but look at what happened the last time we did this back in March. So right here, on the chart, you should be able to see that zeroing in, but that is a bearish engulfing candle. What happened? We went down to the 20-day, we rallied a little bit, did not break out, and then eventually went back down again. Is that what we're going to do here? I think it's possible. And here we are, bearish engulfing candle again, right there. Come down, test the 20-day, come back up, slightly lower high. Are we going to go back down like we did here? I don't know. But this is a group that went up a lot from October. There's the 9,000 level I talked about. And we got all the way to 21,000. I mean, wouldn't it be okay if it pulled back to like 17? I mean, you'd still be at 17,000 versus 9,000. How about 16? I mean, that's basically where we broke out probably about 16.5. Probably got some gap support around 16.3, 16.4. I mean, would it be a horrible thing to go down there and have some of that money rotate to some other areas? It wouldn't be. And you know what? If we got back down to that level, I'd probably be pouring back into semiconductors again. But right now, it's all about managing risk. When I look at charts, it's not about being right or wrong. You know what? If semiconductors go back up and they break out again and someone says, oh, you were wrong. You said semiconductors were topping. you know what? I'll probably be very happy that they're breaking out because it probably means the market's doing extremely well. And I'm bullish the market. I'm just looking maybe for some rotation. It just makes common sense to me that after going from 9,000 to 21,000 in about 7.5 months, that pulling back to 16 or 17,000 wouldn't be a horrible thing. Last thing I wanted to do is just go over a couple of charts I thought look interesting. Notice that the lower highs in the PPO, this is Qualcomm, and then the higher highs in price. And you see this up here, we got an island reversal, right? Right there, island reversal. And then also right there is a gravestone doji off of an uptrend. So you gap up, you trade up higher intraday, and then you come back down and close just about where you opened. So most of the action took place higher and you come back down. So there's your gravestone doji. And then, of course, we reversed off of it. What I look for when I see a negative divergence and I get a reversing candle like that or a reversing pattern, and that island reversal is definitely a reversing pattern. You can see that we had it a little bit up here where we moved up. It was a black candle instead of a gravestone doji, but then we gapped back down, left it on an island, and we were weak for a few days. This doesn't mean that we're going to be weak for months or years. It's a short-term reversal signal. Here we had the PPO going up. We reversed, went back close to the 20-day. Here we reversed with a negative divergence. I look for 50-day tests after that and or PPO centerline tests. Well, here we got down almost to the 50. You should be able to see that right there. And then look at the PPO right at the center line. So now you can see we're starting to turn back up, and I wouldn't be surprised. Maybe we get a cup. Qualcomm could go back up. Maybe we just get some sideways. Maybe this is the start of like an ascending triangle. Maybe we will move back up to 220 something, put in the, the C of the ABCDE pattern, and then we come back down higher low. Maybe we hit the 50-day when it gets up here over to about 203, 204, and then go back up again. I don't know. I'm just speculating. It's something that could happen. Anyway, getting back to that 50-day, though, once you get back there, in my opinion, the reward to risk starts to look better from a bullish perspective. When you get these reversing candles, negative divergence, that's telling you that the risks, if you're long, you're taking on a lot of risk. So that's a good time to take your money off the table as a short-term trader and see if you get that pullback. I mean, if you did, you get out at 225, 227, and you can get back in at 195. What's wrong with that? Works for me, especially if it's in an IRA or something. If you've got something that's not taxable, all the better. You can get out top, get back in lower. You don't have a tax bill, and you get back in cheaper. So anyway, a couple other stocks I wanted to show you. Moderna. So Moderna really looks bad if you look at this, doesn't it? I mean, it's been going down now for about 6 weeks. It looks really horrible, except notice that AD line really isn't dropping much. So yeah, we've had a couple. This one big red candles, no doubt that was a bad day. But a lot of these other days when it looks like it's going down, you see tails, meaning that in the morning we were going down, but in the afternoons we were recovering. And as a result, we weren't really seeing much deterioration in the AD line. So that tells me there's still buyers out there. But we've been able to work our way all the way back down to where we gapped up and took off back in early May at the 115 level, 114, 115. And that's right where we just got back to. So I think this is going to be an interesting chart from here on out on Moderna. I wouldn't be surprised to see a move back up to test the 20-day, maybe come back down one more time, maybe move slightly lower below 115, perhaps print a positive divergence. And then maybe Moderna takes back off again. This is an area that I think is very interesting. I mean, you can see here the high was about 116 back in, this would have been all the way back in January. And then we had these tops coming across here at about 115. So you can see it right there and right there. And then we move up above. We come back to about 117 right there. And now here we are at 115 again. So this could turn up from here. The last chart I want to show you is Garmin. because this is one I added personally yesterday, or well, actually it was on Wednesday, not yesterday, or not Thursday. But let's go up here and take a look. So what I liked on it, and actually let's go to a 3-month chart. I think it'll show up a little bit better here. So you can see the move to the downside. This was the huge earnings report right here. So this is where we got the gap up. Stock went up. We opened at what, 152 and change. We got all the way up to into the 170s without really any weakness. And then we pulled back, and now we're back here at the moving averages. On Wednesday, I loved this reversal right here. So it looked like we were breaking down beneath all of these lows over here. And then we reversed, came back up end of the day. And a lot of times that starts a trend. So I got in on Wednesday, saw a little bit of upside action on Friday. Volume picked up, which I liked. And now what I want to see is a move back through 164. We haven't had a close above 164 since we were at the high back at 170. So this very next day, we went down, closed below 164, and every rally attempt has been thwarted at that 164 level. So GRMN, if it can get back through 164, I think it quickly moves back to 170. And then we'll see if we get the breakout. And if we do, this is one that can run. Look at that AD line. It's been going down, sideways to down for a while. And look at the AD line setting new highs. That's just telling you a lot of these tails, morning weakness, afternoon buying. And believe it or not, when I talked about Tesla, when it was back in the 160s, I said it was being manipulated and that we were seeing a lot of movement to the downside in the mornings and we were rallying back. I'd said the same thing with Apple when it was back in its 160s, 170s. And sure enough, now it's up 220, 226, whatever it is. So these stocks give us clues. I'm not saying they guarantee us anything, but again, if we're trying to manage our risk, being in these stocks near support, when it looks like maybe they're getting ready to take off and we've got some of these clues that are telling us we're going to go higher, that's when I want to, take on a little bit more risk and put my capital to work. So I thought GRMN was a really good example of that at the end of the week. Still, I mean, right now I would say on GRMN, we're between 158, 164 trading range, and we're sitting at 162. So it's not like we can, jump up and celebrate some kind of a major achievement here. First thing we need to do is get through 164. But I think the end of the week was at least a good signal. We'll see if we follow through on that next week. All right, that's really what I had for today. I really appreciate everybody joining me here for this market recap. If you like the video, please hit that like button. We certainly would appreciate that support. And make sure you subscribe to our channel. We are doing videos from time to time. I'm going to try and get another one out this weekend at some point. But if you are subscribed and you turn that notifications on, ring that bell, that will enable you to see if we publish any more YouTube videos. You'll get notified of that, and you can check those out. But anyway, enjoy your weekend. Hopefully you had a nice 4th and you returned back today safely. And just enjoy the rest of the weekend, and we'll get back at it next week. Happy trading, everybody.